And so, Lyn, we want to find out what is going on. My first question to you, first of all, welcome back to Bankless. It's great to have you. And then could you answer the question, is this the end? Like, are we all going to make it? I think a lot of people are worried. I'm worried myself. What's going on here?
Happy to be here. Thanks for having me. I think we can divide it into a couple of different time frames. And so in the kind of the big macro scale, I've been using the framework of Ray Dalio, the long-term debt cycle. And so in that conception, it's the end of something big, right? But of course, the end is a long process, and it can be a decade-long process. So I think that basically, with the long-term debt cycle, every several decades, when you reach a massive amount of debt, when you go down to zero interest rates, and you have kind of just massive amounts of debt in the system, usually you go through some sort of currency devaluation and system change, right? So it's not the end of the world, but it's the end of an era, basically. And I think that's something we're seeing in a number of markets. But to get less doomy than that, if we focus more on the near term, we're in a cyclical downturn, and not all cyclical downturns become recessions, but some subset of them do. And so when we look back over the past, let's say pre-COVID, we had like a 10-year long, economic expansion in the United States. We still had 3 cycles within that decade-long period of accelerating growth and then decelerating growth. And it just that the decelerating growth never became negative growth. It never became an outright recession, even though you had a couple near misses there. And so what we've been in over the past more than a year now is a decelerating growth environment. And then combined with the fact that this one is so inflationary, kind of leading up to that, that this one is becoming more severe and is kind of starting to look like a recession, at least by many indicators. So it does not look like a recession in terms of employment yet, but by most other, especially leading indicators, it does look more recessionary. And tying this into crypto, to the extent that I'm here, historically, when you look at the Bitcoin and crypto bull markets, a lot of people tie it to the Bitcoin halving, which I think is relevant to some extent, but it also actually matches up very, very closely with these economic accelerating and decelerating environments. And so, for example, we can use the Purchasing Managers Index. It's kind of a go-to macro indicator for economic acceleration or decelerating. It looks like a sine wave over time, and they average roughly 3-year cycles. And it just so happens that all the Bitcoin bull runs were during these rising PMI environments, and all of the downward or choppy sideways periods were in declining PMI environments. And of course, that all of crypto kind of goes up and down together, maybe with a little bit of a lag. And a lot of what dictates the PMI environments is also liquidity conditions. And so central banks and kind of dollar liquidity around the world, generally, one of the big questions was, for example, why is Bitcoin not serving as an inflation hedge? And of course, that would extend to any sort of finite token. Why are these things going down when you ironically have high inflation in fiat currencies? And there's actually really good charts out there that show, Bitcoin in particular. I use that one because that's what most of the macro people will look at, because that's the biggest, most liquid one. And you'll see that, in rising global M2, so rising global money supply year over year, Bitcoin does very well in that environment. And now we're actually in a period where money supply is growing more slowly than it was a year or two ago. And you have multiple central banks, mainly the Fed, kind of pushing back and strengthening the dollar compared to many other currencies. And so when you translate all that back into USD denominated global M2 growth, it actually kind of came to a standstill. So ironically, now that price inflation is happening with a lag from monetary inflation, and some central banks are actually fighting back, it makes more sense as why we're seeing kind of downward price action in a number of assets, including Bitcoin and cryptocurrencies.
Lyn, you focus on like these long-term debt cycles, and you're really, really good at placing us in history, or at least like talking about what parts of history rhyme with our current phase. So I kind of want to pick your brain as to like where we are in the arc of this long-term debt cycle. And for added context, we brought you on, I think our first episode with you was episode 48, January 18th of 2021, and we titled it The Death of the Dollar Dominance. And this was basically a prelude of things to come, where the dollar was really just going to lose its place as like the king of, global currencies. And like we've seen events especially lately, where you kind of see the writing on the wall. And then we had you on in August for episode 76 titled Inflation in 2021. This was when inflation really started to pick up, which was one of the things that we kind of predicted with that dollar dominance. We were going to see dollar inflation. And now here we are in July of 2022. And there's that like GIF, that famous internet GIF of that truck, and it's hurtling towards a wall, and like you just know it's gonna crash, but then it cuts, and then it's gonna crash, and then it cuts again. It never actually crashes, but that feels like the question that Ryan started with, like, are we at the end? This feels like with just like extreme inflation, extremely high interest rates, this kind of feels like the last hurrah before we really start to see like the actual just reduction of the dollar dominance. Would you agree with this arc, and just overall, where are we on this arc, this long arc of the global debt cycle?
Yeah, so global debt cycles are kind of correlated to that global reserve status, but not necessarily the same thing. And so in the last kind of long-term debt cycle, we did see the transition from UK having global reserve currency to the United States. One point I've been making for a while is that, now there's really no country large enough to have the only global reserve currency. That was kind of actually an anomaly that persists in history. It's not something that necessarily has to repeat over and over again. And that I think we're heading towards a more decentralized type of system. And I think that was somewhat accelerated by the events we've seen in Ukraine, right? So you have Russia initiate a war, and then the West responds by cutting off their foreign exchange reserves, and then everyone kind of realizes around the world at the same time that, wait a second, the money-like aspects of these reserves are maybe not as money-like as people thought, right? If they can be censored, if they can be confiscated, whether or not you agree with the reason. That now gives an incentive to a number of countries to be like, wait a minute, I mean, we're holding liabilities of countries that we're not necessarily fans of. What does that mean? What should we hold instead? And so I do think that we are starting to see, for example, gradual shifting away from treasuries by Russia was obviously early to do it. China's been doing it since 2013. Japan has been a big buyer of treasuries, but now they kind of have to protect their own currency, so they're not really buying treasuries anymore either. And you've seen, for example, some of the economic forums, Putin has called for kind of, alternative payment systems, cooperation with some of the other peers, like between Russia and China or Russia and India, for example. India's actually stepped in, even though India's more of a, somewhat of an ally to the West than, compared to China or Russia. They stepped in to buy massive amounts of Russian crude. And so I do think we're seeing a little bit more of a multipolar world emerge rather than a unipolar world. Just kind of a U.S. dominated global order, I think, is shifting into, kind of a more multipolar, multiple centers of power. And right now, the dollar index itself is very strong, but that's in large part because it's heavily connected, it's heavily based on the euro and the yen. And Europe's obviously having a very specific energy crisis, more so than even the rest of the world. And Japan's doing yield curve control with a very tight cap. And so basically, it's one of those things where, it's not that the dollar's weakening right now, it's actually quite strong. But the global demand for it, especially among foreign central banks, is drifting towards that more decentralized model. And if anything, over the past decade, we've seen a mild uptick in gold usage among central banks because, obviously something like Bitcoin or these others are nowhere near big enough or stable enough that for most of them to be interested. And so gold is kind of the self-custodial inflation-protected asset that they could turn to if they want to, hold money for a long period of time and not have counterparty risk.